Compounded over, I mean, I've been doing this 25 years, but the last few years, and I mean, as our business grows, if you do 80 a month, or let's say on average 50, okay, over the last 5 years, then it's a lot of credit. So I see a lot of different things. I'm not an expert in how to fix credit, but what I can tell you is that I've seen what has worked for certain clients, because we see a certain client's profile and we know what the quick fixes can be. And so I'm going to talk about that. I'm going to talk about percent utilization on credit cards, and I'm going to talk about collections. And we're just going to talk about the good and bad and the ugly of all of it, because some of it is fair and some of it's unfair. So I'm here to just let you know what it is. It is what it is until it changes, and then it won't be that anymore. It'll be something else. So when you have questions, probably just chat. I think as more people come on, it's probably better to just put them in the chat and I'll answer them. And Michelle, that'll cover what we advertised as the topic, right?
Correct.
Okay, awesome. So, so with credit, the very biggest thing that when we have a client call us for credit, the number one thing that I spend the most minutes coaching people on that is not out there readily on the internet, like clients just don't know this, and how could they? But the credit score that they pull on some platform, whether it's, I mean, there's so many, they can go directly to the bureaus. Like you can go to Equifax, Experian, and TransUnion, and you can pull your credit score. You can pull your credit score from Credit Karma or CreditWise, or your credit card with Discover, MasterCard, or whatever. Everyone has a credit score. Like that's the biggest thing I think right now that people are addicted to, that I see, is I rarely meet a client that has not already somewhere through a service been looking at their credit score. It's like 90% of the people in this day and age with technology, everybody. That being said, everyone always raises their hand and say, yeah, Jennifer, I already know my credit score. The unfortunate news that I have to break to them is that's great, but that's not the score that mortgage companies pull. So I want to start with the very number one biggest myth out there that no one addresses, because lenders, think about it, creditors don't want you to know that there's other stuff out there because they want you to be tied to them and them be the only one. Like it's unfortunately a very malicious ideology, I think. But I wish that there was just one score. But did you know that there are over 25 models of FICO? So myfico.com is the very best website to go to. In fact, I'm actually going to bring it up as we're talking. I love, and these people pay me no money. They're education. Michelle, if you could have me be able to share. So myfico.com is I think it's the most authentic advice for people. That score that they use, if you do pull credit with them, is usually the closest, what I find when I hear people like, hey, okay, what's the source of this credit score that you have? It's the one that's the closest. So what happens is there's 25 models of credit. So I want you to pretend that you are a big credit card company and you want to bring value to your clients because you don't want them to go anywhere else. You want to have them tied to you. You want them to pay interest to you. You don't want them to have another credit card. You don't want them to. So you say, hey, we're going to give you this free service. And the free service is your credit score. We're going to give you at a moment's notice, anytime you want to click on the button, you can get your credit score. So I'm like, oh man, this is cool. This is great. Yes, my bank gives me my credit score. So behind the scenes, I'm going to let you know the reality of that is that they want to spend as little money as possible, giving you this free service. Okay, this is just basic economic business sense. So the score, there's more than 25 models of credit, and there's different formulas. Some of those models cost more money. And so lenders, we use a certain version of FICO because the versions are constantly changing. You know, there's some programmer out there that's constantly tweaking the data to make the formulas different on these 25 formulas. And some of them cost more money than others. So the ones that mortgage companies use, we all have to use the same credit score. We have to. That's how we can make a loan and sell it on the secondary market. You know, we sell the servicing later. We might sell it to a big bank. We might sell it to, you know, PennyMac or CMG or, you know, Mr. Cooper. Like, there's a bunch of them. Okay. So the way that the integrity of the data is measured is that the credit score all meets the same criteria. That for you're using, you know, FICO version 8.0, etc. I don't even know which version it is right now because it's constantly changing. Because lenders start to change, especially now with COVID. I'm just telling you, they are changing the credit. I'm sure that somewhere they are tweaking the modeling of how it measures stuff. So the reason I'm going over this so profoundly is because it is the largest misunderstood topic that is out there. And I think it's super important for people to understand that when you go to get a mortgage, now, if you're going to get a car, it doesn't matter. It's not the same score that we pull. So I don't care what they do. I care what we do. And the score that we pull, like, you have to let a mortgage company pull your credit. You have to, because if you don't, and you tell me that your score is 700, okay, that may or may not be true. I could pull your score and it could be 640. And then you're like, oh my God, it's wait, why does it say 700 over here? It's, well, because you're using a program and a service that has a different FICO modeling than we're using. So what I care about is that what the one that mortgage companies are using. I don't want to call it a mortgage score because there's no official mortgage score, but the version of FICO that we're using. So that's why I think it's really important for people to understand. And because credit scores are not equal. Okay, so that being said, make sure if you have any questions about that you chat, or if there's anything live, Michelle, you could watch it on Facebook. That's number one. Now, the things that are weighted the most in the one that we do is 1/3 of your score is how you use revolving debt. So revolving is like a revolving door, right? Like, it's up and down. So revolving debt means you have a credit card with $5,000 limit, and it's going up and down. So even when you pay it in full, like, some people say, oh no, yeah, no, I don't have a credit card balance because I pay it in full every month. So that's fine, that's good. But every time your statement cuts off, like my MasterCard cuts off on the 9th. And then my payment is due 3 weeks later on the 6th. So I have a 3-day window between when it's due and when the next cutoff date is. So whatever my balance is, so I pay my card in full on the 6th. And then whatever my activity since the last statement was is now going to report on the 9th. So I hope that makes sense to everybody. It's detailed, okay? Whatever my balance is on the 9th when my statement cuts off. So let's say my balance cut off and it was, let's say that $5,000 credit card and my balance was 4,900 for that activity period. Even though I plan on paying it in full, let's say, it doesn't matter. It's reporting, like, within a day of that statement coming out, it's reporting 4,900. The bureaus only receive information once a month from the credit cards. It's not live information. So the statement balance cuts off. So I really want to explain the psychology behind this because it's important for you to understand. The statement cuts off on the 9th, let's say. Let's say on the 10th or the 11th, the credit card company reports it. I don't know when they report it, but it's my statement, the 4,900. The reason they report it is because what if that month you decide not to pay it in full? You have a $4,900 balance and you have a $5,000 max limit. So every month you have a new choice to make as to whether or not you're going to pay it in full. And I'm going to tell you a real story. I have not paid any credit card interest in 10 years. This is a true story. I have paid in full every month. I have a MasterCard and an American Express. Every month I have paid those balances in full. But a couple of months ago, so we're talking 10 years, we're talking 120 months. A few months ago, I just needed a little breathing room. And for 2 months in a row, I took 2 months to pay off a balance. So I paid a little bit of credit card interest, which it really irked me to have to do that, but I did it. After 120 months of not doing it. And let me tell you, Amex was super happy, I'm sure, because they haven't gotten any interest out of me in all this time. So I changed my habits. It is that simple. You can change your habits at any time. So everything starts new every time a new statement cuts off. So statement cuts off, let's say on the 9th, and you can check, you just look at your statement and see when your statement cuts off. That's how you're going to know. That's what's reported to the Bureau. And so that is what calculates and then Jennifer comes in on the 15th and I pull your credit because your bill isn't due yet. You're not due till the 6th. So you still have a couple weeks to pay your bill in full if you want. So at that time, I pull your credit and bam, you have a $4,900 balance and you have a $5,000 limit. So guess what? 4,900 divided by 5,000, you are at a 98% utilization of your credit card. And in credit formula terms, when you're trying to get a mortgage, that is no bueno. That is not good. So the secret, when we need to get someone's score down, if let's say you're one of those people where like, no, I pay my credit card every month. My percent utilization shouldn't be high. It's like, well, it was just the unfortunate timing between when your statement cut off and it was reported and you paying. Like it's just weird. It's never perfect. So what we do is pay down your credit cards, get me a 0 statement balance or get me a $500, within a 30% level, like get me a 1,000, pay it down to $1,000. I don't know, but let's correct the Bureau to make sure that your correct balance is percent utilization. And that right there, like I do these modelations, I don't even know if that's a word, but I do these simulations for people because I have access to that on my end. So I pull credit and, let's say the client needs 40 points in order to get in the next credit tier so they get a better interest rate. I'll kind of look for opportunity. And the only thing that you can really change in the short term is credit card balances and removing an error of a reporting. Like let's say you have a collection that's reported, and we'll talk about collections in a minute. If you have a collection that's reported and it's not valid, okay, well then you have to get it removed. Like that's the only way to correct it. So sometimes, so we'll look at the simulation and we'll say, hey, let's do these things. But this stuff takes time. Like to do a credit rescore, it's 10 business days once we get the letters proving that these things are paid or paid down or whatever. So it's super tricky. That's why people should pre-approve sooner than later. Like I think people should pre-approve 6 months ahead of time, honestly, because then if we do have to make credit movements, we have time to coach you on credit and coach you like, hey, have a couple of reporting cycles that are coming up where you're below the 30%, and that'll make your score go up. And so I actually had a couple, I repulled their credit this morning. I talked to them in June and they were at a 716. Their credit was 716. And then they really needed to be above 720. That's the kind of the next tier that was going to get them a better rate. And they paid down over the last month and a half, they paid down like $6,000 in credit card debt, got their percent utilization down, and I re-pulled their credit with their permission this morning, and they came up 16 points. Sometimes the points are more drastic depending on the percent utilization, but that's the first place we look. So if you know that you're going to buy a house in the next 6 months, start working on your percent utilization now. And it's a super simple formula. You take the max credit limit. So let's say your credit card has a 5,000, just simple math. Let's say your credit card has a $10,000 limit. Don't spend more than 3,000, period. End of story. Just don't do it. So not everybody has the ability to pay credit card stuff down. So, you know, it's unfortunate, but everybody's situation is a little bit different. But if you can, it really will help you when you're, and that's why it's good for people to talk to us first before you start. Like, that way we can advise you which accounts might be more efficient for you to pay down. Like if you only have 5,000 to pay down credit cards and you've got 12,000 in credit cards, you're like, Jennifer, what do I pay first? Like, talk to a mortgage person. If it's not me, somebody else. I don't know. I don't know if all lenders know as much about credit as I do. I love the dynamics of the moving around. So I'm super passionate about credit because I want to help people get the best rate. Not every lender works that way. So you just kind of have to find someone that is going to help you. But that's the first thing I really want people to know, because understanding these things that I've talked about is the very basis. It's the foundation for understanding your credit. Number one, we went over what the formula is and what it isn't. We talked about that. And number two, we talked about the number one area that you can get your credit to to move up is percent utilization. So I'm going to pause for a minute because I have a couple questions.
Can you see the questions in the chat, Jen?
Yeah.
Okay.
So when do you recommend to make your payment? 3 days before the statement balance? So that depends, because you want you want your balance, you want some type of balance to report. So I'm going to get a little more there's one more layer to this that I didn't talk about yet. So your question is perfect. Having no credit and showing a zero balance every month, like let's say you race in 3 days before to just pay it off. Well, guess what's going to report? Zero. So when you have a dormant credit card, even though you've been using it, you pay it to zero, so nothing reports. So I pulled a credit report of someone the other day, and that is exactly what happened. They had 12 months, the last 12 months, they have a secure credit card that someone must have advised them 18 months ago to take out. And I could see that for like 6 months in a row, I could see 18 months ago that they had a balance of like $400. And then all of a sudden they've had a year where it's been dormant. And I'm like, well, what have you been spending on it? And they're like, well, no, I don't want to use credit. I don't want to show any credit. I don't want to. And I'm like, well, that's been hurting you because you have no other credit to speak of. So for the credit bureau, the score, you've been dormant. Even though you've had activity on the thing, because you race in 3 days before, Luce, to answer your question, when you race in right before and pay the whole thing off, it's going to report zero. So calculate what your 30% is, or do like 10 to 20%. Like, and you only want to do this. I know this is complicated, but I'm giving y'all the secret. I'm telling you how the model works. You can either follow my advice or not. I'm just telling you, this is the way to get a higher credit score, at least in the short term. So when you know you're going to buy a house, that's the only time you need to pay attention. Otherwise, just do what you're normally doing. That's fine. But the percent utilization is how you're rated. And so you want something to report. So have enough activity on there and have the balance on the statement be at least 10 to 30%, no more than 30%. Because literally like 30% versus 32%, that's where the algorithm is tweaked differently. That's the secret, is being below 30%. So Luce, if you run in and pay it a few days before, pay it down to like 20% to be safe. So it reports something. So you're not viewed as dormant, and let it report. And then after the statement reports, just go in a week later and just pay it off. But the percent utilization is the largest area of opportunity of how y'all manage credit cards that we see that get people in trouble. Not in trouble, but just, you know, gets their score in trouble. And so that's the number one way. And so I have another question, Raymond, what does your score need to be to purchase a home? So it needs to be at least 620. So there's different programs. So on a conventional loan, if you're putting more than 20% down, you can go down to 620. If you have PMI, so if you're putting like 5 or 10% down, you've got to have a 680. However, there's a segue to that. Right now, the way the automated underwriting is tweaked, if you're in a conventional loan and you have below a 700, even though the guideline says you can have down to like a 660, I think, you're not passing automated underwriting. So there's two answers to your question, which is a very good question. And that's why people need to get with a lender as soon as possible. So there's what is published as the guideline, and then there's what's accepted through the automated underwriting, because we have to run all the files through automated underwriting. All lenders have to work this way. So I would say to be in the safe zone, have above a 640. 640 on FHA, most lenders are at 640 right now on FHA. It used to be down to 580, but right now with COVID, lenders are more concerned about your credit than they were before. And so it's more important than ever right now to pay your stuff on time. Like I had a time years and years ago, like over a decade ago, when I told y'all I hadn't paid mortgage interest, it's because I got myself in trouble with credit cards. And there was a time for about a year that I literally was within a day of being 30 days late every month, but I always made it because I was super organized and I had a little Excel spreadsheet. And I was like, okay, because I was struggling at that time and I had to watch it. So if you're in that category, you have to watch those due dates. Do not be late, because then they put a late payment on there of 25 bucks or whatever. And if you don't pay that, then they're going to report you late. So like, it's super complicated. So just be on top of it. But to answer your question, to safely answer your question, you need to have a 640. Different lenders have different requirements. There are some lenders that are going down to 600 on FHA. So FHA stands for Federal Housing Administration. That loan is more lenient. But the max loan amount on FHA is $331,000. So people that are buying a larger house than that, they have to go conventional. So they need to have, my suggestion would be strive to have above a 700. So I know I'm giving you a long answer to your question, but the answer really is it depends. So getting with a lender sooner than later to figure that out is super smart. And Raymond has already done that because I know he has already called us. So that's, I'm glad you're on today. There's another question, Luz. Good advice. Thank you. If you have a 640 and have 20% or more down, is it better to have conventional or FHA? If you're a 640, it depends. Sorry, again, it depends on what your debt to income ratio is. So conventional, currently on conventional, with that credit score, you can have up to 50% debt to income ratio. FHA, you can have 55. So it depends on your debt to income ratio, my answer. And it depends on the rate combination, rate PMI combination. So I'll give you an example. I have a client that is under contract and she's buying a $340,000 house and she's putting like $120,000 down. But so like it's 25% down, and we are still doing FHA because, and she has like a 700 credit score. So the reason we're not going conventional is because her debt to income ratio is 54.99%. Like she's right below the limit, but she's like, I have to have, like she has to have this house. So I want to help her get this. This is like her dream house. And she's like, I don't care that I'm paying PMI. I want this house. So her rate and PMI combination, because of her dynamics at 2, were actually lower than the loan without PMI. So the answer to your question, Luz, is it depends. So debt to income ratio, credit score, all go into how I will answer that. The cool thing is there's ways to get creative. So FHA loans, you know, even though the PMI, even if you put 50% down, you have to pay PMI for at least 12 years or 11 years on an FHA. But sometimes we have to look at the dynamics. You know, we have to look at time value of money and getting in a house now before values start going up and rates start going up. So there's lots of different things to consider that we work, or I personally work with clients about and find out what's best for them. I find out what their, you know, what their goals are, how long they're going to live there. There's so many ways to answer some of these questions that y'all are asking. Very, very good questions. Y'all are doing great. Like, I promise I did not plant these questions. Like, y'all are asking them, which I love. So I hope it answered that. Another one, if you don't have any credit cards because credit score is low. So that's a great question. So the best way to get a credit card when you have low credit is to go to a bank and ask them for it's called a secured credit card. And it secures the credit card with a savings account. So you don't need a lot of money, just like $300. And all the big banks do them, I think. But right now, because of COVID, I've heard some clients telling me like, oh, I went to my bank and they wouldn't do the credit card. And I was like, really? Every bank's a little different. So just find a bank that'll do it. There is a bank that'll do it. So you just need to keep searching because they want your business. They want to earn your trust and they eventually want all your deposits over there. So that's the method to their madness. So it's called a secured credit card. And let's say you open like a $300 savings account. They'll give you a credit card for $300 limit, which means based on what I taught you to be less than 30%, try not to, in any given cycle, don't spend more than $100. Like just put gas on it, or like you literally could spend $10 and you'll still generate a credit score with $10. The percent utilization above 0 is key. That's the key, below 30, that's it. And so open a secure credit card and that will start to earn points on the credit spectrum. Okay, so I hope I've answered your question there. That was a great question. There's another one. Oh, thank you, Max. Wonderful tips. Thank you, thank you. You were able to increase your credit card limit while reducing its balance. Would that be more helpful? Yes, you can possibly do that as well. So raise another way to do it. So like you could pay down a card to below the 30% with just cold hard cash, or you can contact your creditor and you can raise the limit. So yes, you could do that. That's definitely a way to do it. So kind of calculate what the 30% is. What I am finding right now, I've heard from just some other clients, some people's limits are being reduced. And we see this happen when the economy is struggling. So I saw this happen back in 2008 when there was that big mortgage meltdown and, you know, there was kind of all that stuff that happened. And it's happening again to where the clients that are consistently, when your percent utilization is consistently above like 80 or 90%, like if you're constantly maxed out and you're always making the minimum payment, which, I mean, it's happening. Some people are having to live off credit. Like, I get it. And they're lowering your percent utilization. They're lowering the limit. So unfortunately, the reverse can be true as well. But to answer your question, yes, you could raise the limit if they will do it. And they'll usually do it when you're, you know, not carrying a maxed out balance. But just be prepared for those of you that might be watching and you're consistently above the limit. Like, be careful and watch it, because they could do the reverse on you. They could say, yeah, we're lowering you to 4,000. because they want to keep you. And then the next time you report to the bureau, your limit is 4,000 and your balance is 4,900. And so then your credit score is going to go down even lower because you're above, like, so I didn't mention this before, but like the total bullet to your score regarding credit card debt, like 98% utilization is bad. Over the limit is worse. So if we pull your credit and you're over the limit by even $10, like it doesn't matter. It's a formula. It's an algorithm that's tweaked. Like there's no human analysis. It's like you're either at the limit or you're above it or you're below it. Like there's no gray area. So we have seen people that are even $10 above because, you know, they like add a late fee or add the interest. And just without you realizing it, you're above the limit, or they've lowered your limit and you just didn't realize it. And now your score goes down even further because you're below the limit. Like it's super annoying, but they do it for a reason. They do it to protect themselves, and they do it to keep you from spending too much because they want you to pay your bill on time. So they have their own algorithm that they're watching every month, and that's why they do it, because their risk department is assessing that you're higher at risk of not making your payment because of how you're managing your credit cards. So try to be below the limit on every single time if you can. So even, and when it's harder, the harder part is when clients, like let's say, Raymond, you do that secured credit card. So the secured credit card, it's only $300, right? Like you're thinking, oh, it's only $300. It doesn't matter. It's the percent utilization, not the quantity. There's no judgment about the quantity. It could be $300 or $5,000. The point deduction for the percent utilization is the same. Whether that's fair or unfair, it's just the way that it is. So the next quick thing that this leads me to, that I'm gonna finish with, is collections. Collections, it doesn't matter the amount. Just like it doesn't matter the amount of the credit card limit, like 98% utilized is 98% utilized. Same thing with collections. So if you let something go to collection, or you have something that you don't even know, like you just, I mean, like you just didn't notice the, like, oh, the medical bill, like no, insurance was supposed to pay that. So we see people that have collections that they didn't know about all the time. They might have moved, or it's bogus, or it doesn't matter the reason, it's on there. And so what the algorithm is tweaked, and this is the one that mortgage companies use, not, I don't know about all those others, but percent utilization of credit cards and collections carry the highest points, period. So if you have a $20 collection, it is the same point deduction on your score as a $10,000 collection. As unfair as that is, it's just the way it is. Like I'm teaching you I'm just letting you know, real facts, no BS. Like this is currently in today, 2020, that's how it works. I'm not saying it should work that way, but it does. And so the act of the collection, so the algorithm is, in the formula that we use, is tweaked to think, like whoever programmed it in there, it's like, well, they weren't paying attention and they were sloppy and they allowed this bill to go to collection. That means that there's a higher percent chance that they're gonna forget to pay the mortgage, and they're gonna be sloppy about that. And so it's tweaked to think that way. And so collections or late payments in the last 2 years is another bullet to your credit score, because the last the model formula is tweaked to think that the last 2 years of your activity and what your habits are is the best indicator of the next 2 years of how you're going to pay the mortgage. So like you could have literally, like you could have 10 years of just, you know, or 15 years, it doesn't matter, as many number of years of just fantastic credit, like perfect, pristine, rock star. And you have one collection 6 months ago. That point deduction on your score is 100 points. I am not lying. Like, I could not make this up. I see this happen where I'll get a client and their credit is perfect. Like, they have like 40 years of credit. Like, this was like an adult, like a almost senior citizen. Like, he was older. So he had so much credit. He had mortgages, he had tons of credit. And he had one collection that, and I think it was bogus, but the score doesn't care. It's on there. And so I coached him on how to call, like you call, I coached him on how to get it removed, and he did. And he got me a letter saying it was removed, and we did a rescore, and he literally, it was like 108 points that his score went up. So it went from like 680 up to like 780, 790. That one thing. So you can have someone with pristine credit and one event had that big of an impact. So, you know, I'm just coaching y'all on what I see. And so it's, you know, again, these other formulas of credit, I don't know how they attack those kind of issues. I just don't. So I can only coach you on when I see the mortgage score that we pull, what happens on that. So I have another question. How about if you pay your collection, will that raise your score? Okay, that's a fantastic question. God, I swear I'm not planning these questions. Y'all are fantastic asking. So another secret is paying the collection to 0, and they update it on the credit bureau saying that it's been paid, doesn't change your score. Because even though that's the right thing to do. I mean, if you really owed the money, then you should pay it. But you need to ask for deletion. The only way your score is going to go up is by having it deleted from your report as if it never existed. And this is the part that just super annoys me about the credit system, because I see many, many clients have a lower score than they should because of a measly little collection that, you know, they didn't get the mail, or they never got contacted by the company, or it's bogus, or like whatever the reason. But there are a handful of collection companies that will let you pay for deletion, and there's a handful of companies that don't. Now, if you go to my YouTube channel and watch to loanwithjen.com, Loan with Jen on YouTube. In fact, our guest today that's sick, Louisa Deason, we wish her well. Her and I did a video together about collections. And what she said was that you have to really know how to go after them and use certain language that scares them. Like according to, you'll have to watch the video, but according to whatever finance code, that like they have to lawfully, they're supposed to remove it. But like, who knows that? Like, who knows to say that? Like, who knows? Like, it's weird language, okay? So you have to know how to work those people, because these collection companies, you know, they're out for themselves. Like, they only get paid if you pay. So they will, I just don't want to talk bad about anybody, but I am not a fan of collection companies and the tactics around collections. So I wish that it was different, because we also see collections that get paid, or that not get either paid or not, but we see things that get sold to different collection companies. Like even after 7 or 8 years, when it's supposed to fall off, it'll like reappear on your credit. And it's like 13 years old, like literally like old, but it somehow reinvigorates itself on your credit. Like it's a rat's nest is what it is. But to answer your question, you got to make sure that it's deleted off your credit. That's the only way. So if it remains on your credit and the balance is 0, It's the act of the delinquency that's being calculated in the score. So that's something that's super important for people to understand. Deletion is the only way, because you still, this is not what I'm saying to you, Luce. I'm saying this is how the algorithm thinks as much as it can think. You still were sloppy and let it go to collection. You still ignored something that got to that point where it was in collection. Whether it's valid or not, that's what the algorithm thinks. And so that sloppiness is what's being rated, not that you did the right thing and paid it to zero, but get it deleted. So try to get things deleted when you're paying them. And like I said, some companies will and some won't. Oh no, we don't do that. And there's no way to know who they are. There's just no way. That's why sometimes it is really good to use people like Louisa Deason. She's with Deason Consulting Services, and they help people with, I mean, sometimes it's worth it to pay someone a little bit of money to get the stuff off, because then it'll reappear in 8 years and you'll be upset all over again. Like, they do serve a purpose. So do check it out. You can just Google Louisa Deason. She does a really good job. We have another question. How long does it take to get it off your credit? And if to better the payoff, does it stay on your credit if paid? So Raymond, I kind of did answer that. I'm going to repeat it because that was a really good question. So if you pay it, yes, it stays on your credit. So let's say that it's a collection. Let's say it's a medical collection and it was $150 and you paid it because you're like, oops, okay, I got to pay it. Insurance didn't pay it. I got to pay it. So you pay it. So now it's going to update to your bureaus as $150 on December of 2018 that the collection started, and that you paid it. Let's say you paid it January of 2020. So the date of last activity is January 2020, because that's when you paid it, and it's going to show a zero balance. So now your score goes down a little bit again because your date of last activity is now more recent, which is super unfair, but that's the way it is. I'm just here to tell you all the secrets of how it works. So now your date of last activity is not 3 years ago, it's 6 months ago, and it shows zero. So your score actually goes down a little bit. I mean, I think if you do the right thing and pay collections, they should automatically be deleted, but they are not always. So I hope that answers your question. Normally, let's say that you bulldog them the right way and say, hey, you know, can you delete it? And they say yes. Get them to send you a letter. And I would go a step further and maybe write to the bureaus and say, hey, I paid this needs to be deleted. And it usually takes about 60 days to go off, because remember, creditors only report once a month, if that. Some only do every other month, because they have to pay money. It costs creditors money to update. They do not want to pay more money than they have to in order to report you to the bureau. Like, they don't. If they can save 10 cents by reporting you next month, they're going to do it. So it is not live, is what I think I want to hit home. Another question, how about if the collection company makes a lower offer to pay it off? Yeah, that would be great. I mean, negotiate, but get them to delete it. Like, deletion is the key. So I don't care how much you pay. It doesn't matter how much you pay, but if it stays on there, they're going to report settled for less than full balance. And that does something to your points too. So it's super tricky. But that website that I mentioned, I'm going to actually share screen here because we're going to wrap up here in a minute. So I like myfico.com. I just feel like it's a really good comprehensive. And I went to the education tab. So like, I was at the main page, and you don't have to pay anything to get the education. So I would just click on education. And over here to the left, there's a bunch of good little, like the one that's really fun that I learned some things that I didn't know was, oh, this is a good one. FICO score versions. Here you go. Look at this, people. Look at all these versions. So how do you know if your credit card that's giving you this free service to make you feel good about them and warm and fuzzy, how do you know if it's FICO score 2 or FICO Bancorp score 9? Like, you have no idea. So all mortgage companies use the same one. You can see here there's one in auto. And then the most widely used version, oh, cool, they put it in even categories. Credit card decisioning, there's 7. Mortgage lending, score 2, score 5, and score 4. Newly released version, right down here. Do you see how there's, so how do you know that the version you're getting isn't one of these older versions? Like, how do you know? So do y'all see how it's just like super confusing? So rather than trying to figure it out, just make sure that you or your friends, when you're talking about it at the party or on your Zoom meetings now, because we're not going anywhere, say, oh my God, you need to get with a lender as soon as you can, because those credit scores aren't the same as what mortgage companies pull. So make sure to get with a lender as soon as possible and let them pull it so that you'll have something to work on if you need to. And we might even just confirm that, hey, you're in the right place. You don't need to work on anything. You don't need to pay anything down because it's not going to make a difference. So don't worry about it. That's it. So I'm going to start to wrap it up. I could just literally talk about credit all day, but I think I've hit the most high points is credit cards and collections are just the biggest things that we see that can easily be fixed, hopefully, on credit. And I'll mention something. The lower your credit is, the harder it is to come up, unfortunately. So like my client that was the 100 points, he had this great credit and that one collection. That's why his score came up so quickly from that one deletion, because he was otherwise perfect credit. So his 680 came up to 700 or 780 like super quick, because his credit is like a building made of steel. So he can have a little mini meteor can hit his building and it's fine. So I'm comparing your credit to a building. But if you're consistently late, and if you had like, let's say I saw someone's credit the other day and she had good credit, she had some good credit, but like she had a few accounts that were late in 2015, she had a couple lates on credit cards, 2017, 2018, like every year for the last 4 years, she had 1 or 2 lates. So that's the sign of someone that's sloppy. I mean, I'm sorry, but that's what I'm calling it what it is. Like her bookkeeping skills are sloppy and the algorithm picks that up. So she could have a collection and her score is going to stay down because she's probably already in the low 600s because of that sloppiness. So it's harder for that deletion of one error, one paid collection or whatever. It's harder for her to get up because she's consistently showing the bureau that she's sloppy. I mean, that's how you got to call it. It is sloppy. So now, especially with auto pay, like just put stuff on auto pay, y'all. Like you have to. But I can say to just, I mean, sometimes you don't want to do auto pay because some people are check to check. They have, especially now, like, and I feel you. Back 12 years ago when I had that problem with credit, I mean, y'all, I'm embarrassed. I had days that I had dollars in my checking account. Like it was so rough. And the credit cards got out of hand super quickly. So I have been there and I have paid stuff off. I had to work super hard. Like I was always in front of my computer every day watching due dates, but you have to put in the work. If you really seriously want to change your credit, you have to put in hard work like that to get things done and paid on time. Because now with technology, you can't call them like back when I was in college in the 90s, oh, forget about it. I would get some sweet mom or whoever was answering the phone. Like, you know, I was young, I was in my 20s, and I would call and I would, thank God, I would cross my fingers, like, let me get a grandma on the phone that's super sweet and she feels sorry for me. and she helps me. In fact, I think I had a few late payments that were removed because using that method. Like, I want some sweet person that super understands. There is none of that anymore. Zero. Everything is done by the computer. There is no human. Barely do I see lates, like an auto late or a credit card late. 10% of the time, if that, do I see that kind of stuff get removed. Like, it's only people that have like a small community bank or credit union where you can really actually go in and talk to somebody. Barely that happens. So really just watch everything and be super on top of stuff. So when you change addresses, when you change bank accounts, you have to make sure that you pay attention to auto, like if your credit card or your bank account number changes or something, that's when we see stuff mess up. Like, oh, the auto debit messed up. Well, because you forgot to let the computer know that you had a new account. So that's what you have to be really super careful on. I'm going to answer just a couple more questions and then we're going to be done. How about if the collection company makes a lower offer to pay it off? We answered that one. And then Luz, thank you. You got a log on. Oh, thank you. Okay. No more questions. So thank you so much for joining, whether it was live or on Facebook or whatever. Do check out, I've got like, I think I'm up to like 15 videos about credit on my YouTube, Loan with Jen. I love to talk about credit, if you can't tell. So when my kids are in college and grown and I can travel more, I'm going to be lobbying in Washington about, I lobbied in Washington in the early 2000s for mortgage stuff, and it was so super fun. And I want to do it again, and I'm going to attack credit because I see so much inconsistency, and that's why I'm really passionate about letting people know just what the rules are and how it works so that you can better manage stuff on your end. Because there's not really one, I don't know, I just find that it's hard to find the truth about credit. It really, really is. And I don't know why that is, but I just know that from the credit perspective of mortgage, because I pull so many credit reports, I can tell you from experience of what I see works and what I see doesn't work when trying to change the credit score. I'll end with what I see as a timeline. So what I really try to when I see someone, and I have many, I'm seeing more and more people with tainted credit. Okay, I think that times are hard, and I think, we're seeing a lot of clients that have low credit, and I really do my best to just give them an accurate timeline, whether it's what they want to hear or not. It's the truth. But if you're in the low 600s as your middle score, likely we can get you to above 640 within 6 months. It just depends what's on there. Like, I don't know if it's an error or if it's just simply paying down a credit card. If you're in the 500s, if you're in the low to mid 500s, you probably need 12 to 18 months before you're going to really be in the spot to buy something. And mid to upper 500s, you're probably 12 months for sure. So I say that liberal, like I say it generally. It doesn't mean that you can't break the code and do it sooner. I'm just saying that this is what I see. When your score is in the 500s, it is so much harder to catch up. It's like you're drowning and you're trying to breathe and you're going like this, and there's just not enough, you run out of energy. Like, there's not enough energy behind what's reporting in the credit. And that's probably a bad analogy, but I'm trying to give y'all the psychology behind it, just to put your mind in the right place. And so I tell people, I'm like, listen, sign another lease or stay where you are. Like, I had to tell a guy yesterday, like, you're just going to have to live where you live. Like, you can't sell your house because you won't be able to go anywhere. So sometimes people need to wait it out, and everything happens for a reason. So just like, sometimes I wish I could be renting again, like, and not have to fix stuff and maintenance. And like, there's a good thing about being a renter is that you don't have to, but then there's a lot of benefits of being a homeowner. So if you're super serious, if you're watching this and you're super serious about getting into the home that you want, you have to really pay attention to your credit, and you have to just like you have to face the music of what it is and what it isn't, and just say, you know what, these are the things that I have to change. Go to myfico.com, watch a bunch of my videos, make notes to yourself on what your particular situation is and what you need to do to change it, and then get it done. And a year or year and a half or whatever is gonna go, or however long you have to wait, is gonna go by super fast. And it, you know, it is what it is. And you know, credit, you know, it's not perfect the way that they view credit, but again, it is the way that we are doing it right now. The automated credit stuff is not changing anytime soon. They might change the formulas, but we'll see. I mean, you know, they're constantly trying to tweak it to make it more fair for people, and there'll probably be some more tweaks come out. They're supposed to make it to where medical collections don't count as much, but I don't see it yet, but we'll see. So that's all I have for today. Thanks for jumping on. I really super appreciate y'all's questions were amazing. And I could not have planted questions better myself, actually. And we were able to cover everything. So I'm gonna pop off. Just, I think most of you that are on know how to contact me, but for new people that are watching, just go to loanwithjen.com on the website and you can reach us. We'd love to help. And that's it. That's all I have for today. So thanks for joining, everybody. Thanks for spending your lunchtime with me. We'll talk to you soon. I'm gonna pop everybody out.
Legacy Mutual Mortgage is an equal housing opportunity lender. The opinions expressed here do not reflect those of Legacy Mutual Mortgage.